Okay, let's just dive right into this explainer. Today, we're going to demystify the somewhat complex life cycle of a forklift acquisition. We're going to track this massive piece of machinery from the concrete of the warehouse floor all the way up to the incredibly dense paperwork of your final tax return. Because whether you're a warehouse manager trying to ruthlessly cut daily operational costs or you're a financial controller trying to navigate some pretty strict new compliance standards, you know there's an inherent friction here. How you physically acquire and financially account for this equipment, well, it changes absolutely everything for both departments. So, here is our roadmap for today. We'll be hitting choosing your forklift fuel, structuring your equipment lease, demystifying ASC 84 accounting, looking at the balance sheet impact, and finally, maximizing your tax deductions. Let's get to it. Starting off with Section 1, choosing your forklift fuel and powering the warehouse. Before a single piece of paperwork gets signed, we really have to look at the physical energy actually running your heavy machinery. I want you to ask yourself right now, what powers your bottom line? Look, it is incredibly easy to just default to the fuel source your facility has always used, right? Just because it's familiar. But that single initial choice, it essentially sets the baseline for your entire total cost of ownership over the next decade. Just look at these numbers. When we check out standard industry usage rates, the monthly cost contrasts are just wild. We are talking about roughly $166 a month for electric power versus over $1,000 for propane and nearly $1,200 for diesel. When you extrapolate that out, electric power can generate over $12,000 in potential annual savings per single forklift compared to diesel. Think about that. If you operate a fleet of 10 or 20 lifts, you aren't just saving a few bucks on fuel, you are literally looking at hundreds of thousands of dollars in pure operational capital freed up every single year. All right, moving to Section 2, structuring your equipment lease, or funding the fleet. So once the machine and the power source are picked out, it really comes down to understanding the distinct line between simply paying to use the machine versus taking on the actual ownership and debt. With an operating lease, you don't own the equipment. You essentially just rent it, and you get the option to buy it at fair market value at the very end of the term. Conversely, a capital or finance lease acts a whole lot more like a traditional loan. You take on the full benefits and the burdens of ownership, usually ending with just a nominal $1 buyout. Choosing between these two paths, it dictates the whole shebang of everything else we are about to discuss. Now, the sheer flexibility in how you finance is where things get really fun. You absolutely do not have to be locked into a rigid, flat monthly fee. Instead, you can synchronize your lease payments directly with your seasonal cash flow cycles using these structured options. Have a notoriously slow season? Well, you can use a skip payment program where you literally skip up to 3 payments a year without any penalty. Or say you're getting equipment right before your busy season, but you don't want to pay while you're training the operators. Use a 90-day delayed structure. Your financing can, and honestly absolutely should, bend to the daily reality of your operations. Section 3. Demystifying ASC 842 accounting. The big compliance shift. Okay, understanding right of use, or ROU terminology, is the absolute key to grasping how previously hidden off-balance sheet obligations are now being dragged out into the full light of day. For the controllers listening in, this is where your world completely changes. Even if you don't officially own the forklift under an operating lease, you do own the exclusive right to use it. The ASC 842 standard basically says that this specific right is inherently valuable to your business, and so it must be officially recognized as an asset on your books. Think of this as a fundamental weight transfer. ASC 842 ensures that the heavy, tangible mass of that machine out there on the warehouse floor is now accurately reflected as a financial weight right on your company's balance sheet. The days are gone where you could just casually expense the monthly payment and ignore the massive multi-year financial commitment you've entered into. Which brings us to Section 4, the balance sheet impact. Let's record the data. When you start looking at the dense journal entry differences here, the core distinction lies in expense recognition. For an operating lease, you maintain a predictable, single straight-line expense over the entire life of the lease. It's the exact same hit to your income statement every single month. Nice and easy. But for a finance lease, you are actually splitting that cost into 2 separate buckets. You've got amortization, which, is basically just the gradual write-down of the asset's overall value, and then interest on the liability. Because interest is always calculated on the remaining balance, a finance lease actually front-loads your costs. It hits your income statement way harder in the early years of the agreement. So at the very commencement of the lease, establishing your liability and asset happens progressively. First, you take all of those future monthly payments and you figure out exactly what they are worth in today's dollars using a discount rate. Actually, it's essentially just adjusting for the time value of money. That complex calculation establishes your official lease liability. Then you just add in any initial direct costs or lease payments you made up front, and boom, you have your right-of-use asset perfectly calculated for the balance sheet. Finally, Section 5, maximizing your tax deductions and protecting that bottom line. All right, let's step away from GAAP compliance for a second and navigate over to federal tax law. Look at that massive number. That $2.56 million figure represents the 2026 Section 179 deduction limit, established under the One Big Beautiful Bill Act. For qualifying businesses, this legislation lets you immediately deduct up to $2.56 million of the purchase price of eligible equipment in the very first year. That is huge compared to slowly depreciating that equipment over 5 or 7 long years. And alongside Section 179, the restoration of 100% bonus depreciation offers some incredible first-year write-offs for anything that extends over that $2.56 million limit. But, and this is a big but, here is where you have to be incredibly careful. You've got to ensure your specific state tax rules actually conform to the federal standard. Many states just do not recognize these aggressive federal deductions, which means you might be forced to add all that depreciation right back onto your state tax returns. No one wants that surprise. So it essentially becomes a major strategic trade-off for your cash flow. With a capital lease, you are trading long-term deductions for a massive immediate upfront deduction using Section 179 and bonus depreciation. But if you use an operating lease, you don't get Section 179. Instead, you get the steady long-term capital preservation of leasing. You're writing off 100% of your monthly payments as an operating expense, dollar for dollar, exactly when you pay them. But wait, beyond just the taxes, leasing offers a massive operational advantage too. Material handling tech is advancing at lightning speed right now. An operating lease lets you effortlessly swap out aging machines for cutting-edge technology, like those highly efficient lithium-ion batteries we talked about at the very beginning of this explainer. You get to constantly upgrade your fleet without ever being burdened by the total nightmare of trying to sell off a yard full of fully depreciated, obsolete assets. So, I want you to take a hard look at your warehouse right now. Look at the machines actively moving your inventory, and then look at the paperwork sitting on your controller's desk. Between these new tax laws, the vital shift to electric power, and the strict compliance rules of ASC 842, ask yourself, isn't it time to completely rethink how you finance the heavy lifting of your business?